What's happening, everybody? Welcome to the Gray Report. I'm your host, Spencer Gray. On the Gray Report, every single week, we're breaking down what's happening in the multifamily industry, real estate, and the economy, discussing the latest research reports that are coming out, articles, all the new data, because there's all kinds of stuff that is released, but it's not always easiest to find. And so that's what we over at Gray Capital and on the Gray Report, we're searching for this stuff, putting together and bringing it to you every week. So end of the year, almost 2022. Let's get into it. All right, everybody. Happy New Year. Merry Christmas. Happy holidays. Matt Bosnagel, Director of Communications and Marketing at Gray Capital, joining us in the Gray Report. Once again, Matt, happy holidays, Merry Christmas. And it's almost New Year.
Yeah, same to you. Same to you. It's crazy. This year went by so quickly. And even in, there's this kind of like the dead week between Christmas and New Year's, but there's still a lot happening and a lot of information still coming through, and there's still a lot of activity to expect in 2022. So that's what I've been thinking about all this week, really.
Yeah, it's been interesting. End of the year, people getting kind of final allocations out, trying to deploy capital, also thinking about plans for next year. I mean, 2021's been nuts, right? I mean, so much growth. Real estate was the best performing asset class year over year compared to any other asset class in the world, U.S. real estate. And so people are saying, what is in store for next year? Now still with the coronavirus, sticking around and going into uncharted waters. The Federal Reserve, they've already started their tapering of mortgage-backed securities and other U.S. Treasuries, talking about raising interest rates a couple times. And so how is that all going to affect next year? And so we've got some really interesting pieces. Really good report from Berkadia and RealPage, Globe Street, interesting article from the Times, and also from a piece from NBC, which I think, Matt, is interesting because it's a little bit more of an outsider's perspective on what's going on in the housing market and the rental market, which, that's what we were discussing earlier. And because, we read a lot of pieces that are put out from sources inside the housing industry, whether that's, the property management kind of data firms out there, or just, the folks that are just really focusing on real estate day in, day out, which, you always wonder, is there some kind of bias or is it an echo chamber when we're looking at the same data all the time? And possibly, more people are rooting for the housing market to be successful and profitable because you're still typically selling a product, whether it's insurance or properties or whatever.
And we'll even talk about one of those too. So that's
Well, so let's just hop right into it, Matt. Let's get into this report from Berkadia and RealPage. They put out, we were just talking just before we started recording about how we really like the way that the folks at Berkadia and RealPage put these reports together. I believe it's Berkadia is taking RealPage's, it's a joint report, but I think it's Berkadia that's putting together the report from RealPage's data. And this is all in demographics. So Matt, I guess bring us in. What's your take?
Yeah. Well, just to kind of continue what you were talking about too, it's like there's a difference between getting the data and really interpreting the data, and that's what I really love about the team at Berkadia. Their thought leadership team really does do a lot of great thinking and a lot of unique interpretations and ways of breaking some of this information down and seeing what the implications are. I really like this report because it talks about who the renter population is. And like a lot of the stuff that we're going to talk about today, there is some trend lines that you can see progressing through 2022 and beyond. So very forward looking, really interesting. It's a write-up, like you said, of the data that they use from RealPage.
Yeah.
The graph of the age breakdown of renters, I think, is fairly appealing from an investment standpoint. And you can see this large group of younger millennials that will pass through peak renting years, really in the next 5 or so years. You can see that, and I think it should move the U.S. median age down if everything, given
Yeah.
I'm not. I'm not a demo. I'm not a democ.
No, yeah, no, the
demographic
U.S.
expert.
median age will be going down. I mean, as baby boomers, larger generation, they're can become a smaller generation over time. And millennials are now the largest kind of demographic cohort out there. So no, absolutely. And then really what we're watching for is the Gen Zs and
Yeah.
the Gen Z demographic generation of what are their preferences on housing, because they're really the ones that are they've entered those peak renting years, kind of that mid to late 20s and early 30s. And so what I think is critically important in this report, and again, the reason why I like it is it's a very digestible report, but it's really identifying who are our renters. When we're putting together an in a multifamily investment thesis, we're trying to figure out, where does this property fit into the market? You can't just look at it as an apartment building and just people are going to move. Who are the individuals that are going to be renting and wanting to live at that apartment community? What are the age breakdowns? Where are they working? Are they families? Are they single? Because that's going to tell you. And then what are their incomes? That's going to tell you, what they prioritize. Whether it's amenities or what they value. They may not care about putting in, a new pool or whatever. They really care about having fast internet. And that's something we keep hearing, all the time. So let's just kind of go through this real quick to break it down. Median renter income in the United States. And again, this is national numbers. You want to look at your actual market in specific submarkets. We look in a 1 mile, 2 mile, 5 mile submarket market. Look at all those numbers. Just again, see who are those people living there. But $60,000 median renter income. The mean effective rent in the United States is $1,249. That median adult renter age is 31.8 years, and that median rent to income ratio is 22.6%. And we typically consider 30% kind of that max income to rent ratio that you don't want to exceed. And anytime you're over that, it's considered being rent burden. Median square foot of a unit in the United States is 897 feet. The mean bedroom count is 1.5 bedrooms. And then the median new lease term, this is interesting, 12.7 months. That means there's a decent amount of longer than 12-month leases. I would expect that to be slightly under 12 months, as you'd see more short-term leases or month-to-month leases bring that mean down. Mean number of pets, 0.2 per unit. That's a good number, I think, for for underwriting. We want to know how much pet rent and pet deposits and things like that to account for at your property. But again, the only way to really know is actually get into the rent roll and to see what that actual resident makeup.
Yeah, and before we talk about the cohorts, which I do think is really interesting, kind of the meat of their analysis. What you identified too is the idea that different groups of people like different things, and you may have an investment opportunity that the characteristics fit maybe the starting out single, or maybe you fit a families, but you just have to kind of fit. You have to know what's in your area and do the research and determine, what are the features of your apartment and what are the features of the area. And that's kind of maybe another great way, one more factor of how you can judge the success of your investment.
No, I think that's a good point. And looking at this, this kind of cohort breakdown to me was a little eye-opening, because I did not think families would represent under 5% of all renters. And so again, you're talking about a value add plan. And it obviously reminds me of one of our properties, Suncrest in Indianapolis, where there's a playground in the first question, and it needed to either be replaced with a new playground or just taken out. And there's only 1 and 2 bedroom units at Suncrest. There's not 3 bedroom units. And so what I can take from this report is that, one, families make up less than 5% of the renting pool. Also, in this report, it states that families, and this is, you could have assumed this, but they are obviously gravitate towards the larger unit sizes and bedroom counts. if you've got small bedroom counts and families are going to make up less than 5%, why would you put in an amenity that's only going to cater towards, less than 5% of your resident base? It doesn't make any sense. We should be catering towards the starting out single and the roommates by necessity that make up over 50% of the renting cohort. And then maybe, if you take the starting out singles, the roommates by necessity, and the independent singles or independent seniors, really that's over 65% of who you're targeting. And then you could almost throw in the established couples at 5%, families at 4.9, and the young couples at 4.7, and that makes up 15%.
Yeah.
You could almost throw those into the affluent singles category. I think some families are going to be looking for more of a value, but where this leads to is you need to identify who your cohorts are. The affluent single has a completely different profile than the starting out singles or the roommates by necessity. The affluent singles are looking for the most expensive unit. It states here they are more likely to rent the most expensive floor plan on a property. And we've talked about this at like one of our property Pinnacle on Meridian. It's very high rent. And we said from the beginning, we're targeting people who are filtering by price highest to lowest because they want the nicest thing. Like, sure, cost is always an issue to some degree, but they just want the nicest thing, and they see value in paying. You're going to get what you pay for, which is completely different from 50% of more than probably 50% of the other renters, starting out singles, roommates, and independent seniors, who are much more looking at their budget and are more focused on value.
Well, and that's what I was going to say too, is like space is so important now, and and families want almost 200 square feet more than the younger couple, or and the younger established couples. What was it? Sorry, the starting out singles.
Yeah, the starting out singles. Yeah, they need a place to live.
Yeah,
like they're like, I just need a bed. Like, I was in a dorm room. I was either living in my parents' house in a bedroom, or I was in a dorm room, and you just need a.
Well, and that's what I was going to say too, is if you have a place that has large units, that has very nice units, you may not be good to go for the larger population, and so it behooves you to understand what the preferences of these groups are.
Yeah, well, that's why I always say so often, Matt. We're like, I don't think that these residents care if we put in a granite countertop or not. Like, can you squeeze out a couple more dollars per month? Like, sure, you probably can, but is this what the residents here really are? Is really what they want, or would they put more value into better internet, or a kind of a grill social area? If it's a bunch of starting out singles, well, maybe you want to have community events of singles night and putting people together. Why not? You don't want to put in a playground and granite countertops just because you think that someone else may put value on, or you put value on it.
Yeah. Another thing that I just looked at, looking at this, and you see that this severely favors unmarried singles as the prime renting population. And I also look at this, and kind of mentioned this before, as going through life stages. And when you look at the graph of renter ages, again, I just want to repeat, there is this large population that's going to be entering.
So do you think, Matt, that we should create a multifamily community that's centered around, it's like a singles community, and it's like, do you have like speed dating on Thursdays?
I know of one such community.
Oh, really?
That there already are like mixers and stuff that they have.
Yeah, I'm sure there's like mixers, but like if it's like, no, you come here, that's kind of weird, I think.
Yeah. You'll probably get a lot of guys that are interested in.
Yeah, but there's like a market for it. I guess if it could be done tastefully, there's a market. So I think there's like a hotel in Chicago that probably elsewhere that like it caters towards singles. It's like you go there and meet people. That's
interesting. But you see, I mean, the biggest groups of renters are the ones that are a little bit younger, and the population just passing right through that. And so, we can expect a lot more demand to come.
But we don't want them to get married and have families too quickly, though, because then they turn to 5%.
That's right. Yeah.
So you almost have
Imperfect.
you have to be strategic about it.
Yeah.
Maybe you want to keep them single, but no. Interesting. Okay, so let's pop into this the Globe Street article, Matt. Good one. It's a good one.
So they looked at what's hot for multifamily.
What's hot for multifamily? Sorry,
I think that this is an interesting article. It gives an overview of each of the common categories, like we're talking about core plus, value add, opportunistic. These larger strategies and silos of investment that people pursue, and it talks about how some of the material shortages may be affected, specifically for value add, might be affected by labor and supply chain challenges. But then again, it says, value add is the opportunity to make money on your buy. And so it does look like a lot of these categories are winners. And there's
isn't that the conclusion of this piece?
Really
the real conclusion is that there's opportunity in every aspect and every strategy of multifamily, because housing is in such demand. And I don't think that they go through any of the kind of the challenges of the different strategies right now, because I think you have to just be looking at today's real estate market in such a different lens as you were looking, prior to the pandemic and even early 2021, just last year. It was really kind of March and April of this last year where things really started materializing, and rents were picking up by 10% and now up to 30% in some markets.
Yeah.
And it's always adding value always makes sense, regardless of the strategy. Specifically, multifamily and real estate, we're talking about making some significant renovations to an asset. And, we're in the middle of some of those right now. And it's challenging to even get the materials or to get any work done. And so with rents rising so fast, you have to make a real calculation of, is this even worth it? Is it worth creating occupancy or creating vacancy to renovate units when you're going to get a organic rent increase equal to what you were expecting by spending? Well, you thought you were going to spend $10,000, now it's $15,000. But at the same time, can you now do maybe different renovations? Like we're looking at a lot more amenity improvements, and are there other ways to increase the appeal of the property itself, that ways you don't have to spend as much money but have an equal or a similar impact, but you just get a much higher ROI?
Well, and that's what I think may be interesting, and I'm not sure how much it was done in 2020 or 2021, but the creativity and the multiple options that you may have to have, if you can project, if you can talk to the contractor or the builder, and they say, yes, we can get these materials, we can get X materials in 2 weeks, but it's going to take 2 years to get these materials, then maybe you have a lot of options that you can pick on and decide which ones will make sense.
Yeah.
Because
or just lack of options.
Yeah.
It's just like, all right, we have to do this because it's the only thing we can do.
Yeah.
And I just think reevaluating, what your ROI on that renovation is going to be, and having flexibility. And we're like on our acquisition down in Bloomington, Indiana, Forest Ridge, we raised capital, equity for renovations. We also have a line of credit from our bank because we have a value add plan that we're going to do some units to see what kind of rent premiums we can achieve. But if we find that we can get similar, rent growth organically, or conversely, if we get a huge rent increase, if we really can elevate the property through these renovations, it may make sense to roll it out on all of the units. But the market is moving so quickly right now, we want to, experiment, before we make that final determination. But there's good outcomes either way. There's good having multiple options
And
And
and I
so
think that
it's, yeah.
maybe the silver lining for value add is that, even if you have to delay or if it becomes more expensive to do your renovations, then if you're doing things right, you are going to see some rent growth anyways. So it's it
And
in
there's
a way,
also a big spread, there's also a big gap between certain types of assets called like the C kind of mid B assets, and even maybe B plus, and then these new A assets. Like, when we just bought, again, a nice property built in the early 2000s for 116 a door. And then you see properties that were built in 2015, just a couple years newer, that are trading for over 200 a door. And so, okay, that's such a big delta right there. And so how do I take this 114 or 116 per unit property? What do I have to do to get the valuation of the 200K per unit
Mhm.
asset? And so maybe you're not going to see all of it out of the immediate rent increases from the renovation, but you've transformed it physically to mirror what those brand new assets look like and feel, and that there's a story of you can continue to raise rents because you can really compete with those A class assets. Can you at least split the difference and get a 175K per unit
Yeah.
valuation in a relatively short period of time? And that's what the benefit of the value add does. It allows you to gap up where
Yeah.
most other strategies can be lower risk, but it's much more linear growth. You're just not
Mhm.
going to see that gap.
And I think, speaking of no options, these builders are spending more. They're doing things for longer. It's getting more expensive to build these new units, so they there's a lot of pressure to have their rents be very high for these brand new A class units.
Yeah, yeah, they have to, and they're passing along. People are taking it, and they're selling for record
Yeah.
prices. It is incredible. All right, so Time Magazine, Matt, four charts, four
Mhm.
charts that explain the wild 2021 economy. Um, this is the first chart we want to look at. Yeah, or no, the savings rate is one chart. This is something to keep in mind when you look around. It's like people just have more money than they've ever had before, for the most part. Some people are experiencing, really economic devastation, and it's frustrating how bifurcated, the country is. And it's really not COVID. It's really what the government did and the Federal Reserve have done. Um, but in general, if you were invested in if you were invested in the stock market, invested in real estate, if you didn't lose your job, or if you were able to change jobs and now you have a higher wage, you have so much more money than you did back in 2019, 2020. You can see that the U.S. savings rate has been high for much of the pandemic. It's still, it's pretty much down to pre-pandemic average, but this was pretty significant savings rate, going from basically 10% all the way up to over 30%. Pretty nuts.
Yeah, I think that this is really interesting in how it might relate to the labor shortage, and I wonder if we are going to see a little bit more people going back to work as the savings rate goes down a little bit. Um, what was interesting, I think, about this chart was it seems like there is a return to normalcy. Now it's just a couple months really where it's dipped close to or a little bit below the historic average. Um, but this could be the sign of normalization. I'm kind of hoping for normalization. I like the
Mm-hmm.
idea that people are saving and spending more, but that carries with it inflation risks and labor shortages and a lot of uncertainty and volatility that I just like. I think it's better for investment if things are predictable.
Yeah, that's for sure. But I think it was also a good point you made, Matt, about I think this is going to bring more folks back into the labor force, which is definitely beneficial to the overall economy. Hires and quits. People are still quitting their job. Hiring is still elevated compared to before COVID, but people are still quitting all
Yeah,
the time.
and you know what? And this is another chart that if someone told you that that the quits rate is so high, and I expected to see that red line spike up a little bit more than it did. But really what seemed to have happened was the demand for jobs just increased. The hires rate just spiked up so much, and the quits rate, seems to be trending up, but not necessarily. It's not this.
Well, that's what I think is interesting, is that it's not that the quits rate was up when the hiring rate was up. It's these are new people coming into the workforce.
Yeah.
And then people in the workforce are becoming more and more confident about their economic situation. They feel confident they can quit and go get a new job. And in one stat, I don't think it's on this report, but one stat I saw recently is the new business applications and people going off and starting a business during the pandemic is way, way up. So people aren't not just only quitting and finding a job that pays them more or gives them the whatever work-life balance that they're seeking. A lot of people are quitting and starting their own businesses, which is great for the economy. And that typically happens in recessions. Businesses go out of business, and then new businesses are born. And so it's going to be really interesting, all the innovation, I think, and the growth that you see out of these new companies over the next couple of years.
Well, and speaking of silver linings, that one thing that this crisis has done is really generate some kind of real creativity and activity in certain areas that has jump-started a lot of opportunities.
Yeah. All of a sudden, I mean, who would have thought you can make a whole business about with masks?
Yep.
3 years ago.
Just for one, just as one small example, for sure. Yep.
Yeah. So change in average weekly earnings by industry. No big surprise here that the leisure and hospitality, it's like, you're going to make people stay on their feet all day. People are going to demand to be paid a little bit more, but big 15% increase. That's huge. And so if you're an investor in markets that have a major leisure hospitality industry, you may see some accelerated, rent growth, just because if people have 15% more, that's a big wage increase. Now, I would say it's similar than rent increases in many markets. And everything else is kind of anywhere between the 4 and 6% average weekly earning by industry. So wages are up, not as much as in some markets, and not as much as rent has gone up, but wage growth is definitely a good thing. And really, it's outside of leisure and hospitality, everything is either really just kind of matching inflation, or you're losing your purchasing power based on inflation. So if you're in education, health, you lost 1% of purchasing power. Transport, warehousing, which is interesting because all the supply chain issues, but you've lost 2% of your purchasing power. Manufacturing lost 2%. Construction, you lost 1%. Wholesale, trade, or professional business, you broke even. So just keep that in mind. And that's the hard thing about wages versus being an entrepreneur. The growth is on an entrepreneur tends to be exponential rather than linear. If you just have an income.
I think that one of the most interesting things to think about when you look at that list of the change in average weekly earnings by industry is leisure, hospitality. Those are the ones that were really hurting. Those are the ones that needed the work. Yeah. And every other, even retailers, it wasn't necessarily like doomsday, but it was like hotels and tourist attractions and stuff. And that is what maybe is driving this necessity, this imperative to raise wages and to have people but
don't have an option. They just don't have an option. If you want to continue to operate, you have to have people. So
what's interesting, and maybe just relative to our industry, is construction is only up 5%. That's still losing 1% out to inflation, and we need construction just as much. But it doesn't seem like maybe they have reached that point of necessity where they we
need construction. I mean, a lot of houses being built.
And we talked about this last week. Is construction? These builders have said that they have raised wages and still can't find work. But it may just be a simple fact that they don't need to raise wages yet. They have not found that pressure or that imperative to make that.
Well, and I think it's all illustrated in this other chart that they have, wages and inflation compared to pre-pandemic trends. So they've got the trend line. You can see wage growth has exceeded the trend. To me, but on the next column of inflation, you really see, there was, the reflation, a lot of discussion on reflation versus inflation.
Mm.
And I think for, the period, just post December 20 through halfway through 21, you could absolutely argue saying this is reflation because, we had essentially deflation. The economy was just turned off during the pandemic back in 2020. But, we're way past the reflating, and now we're adding inflation. I mean, it's, old time. And that's what we've been saying, Matt, is, it's just a question of how much for how long.
And to see that gap of inflation
Adjusted wages. Yep.
And even so, if it comes to normalcy, then that's just going to really tweak almost like logarithmically or exponentially. It's going to really turn up the inflation dial, I think, once it kicks into the wages. But again, they've got to feel that necessity, and it may not happen across all industries equally.
Yeah. Fascinating. Well, now just to finish things off, Matt. So this article from NBC, this is what we discussed kind of at the beginning of the Gray Report. It's a little bit more of an outsider's take, although I would say that, the timepiece was more of, just kind of a macro economy. This is more on housing from NBC News. From real estate to inflation, here's what to expect from the economy in 2022. Matt, I think you had a good take on this piece, why it was interesting.
Yeah, so we looked at, just a couple minutes ago, we looked at the multifamily opportunities, and yes, there's opportunity there. This one is looking at the whole economy, and so it's really placing it in context. And one of the things that they said, the top things to watch is specifically multifamily real estate, and it's because home prices have risen, and they still say there's still room for rent growth, because rents. Just because there is not that supply of homes that can meet the growing demand. The average home price, they say, rose 14%. And really they're saying, while home prices may be cooling right now, renters aren't getting that kind of any relief yet. Rents are increasing at double digits. And they say, and I like this because I think maybe because they're an outsider, they feel a little bit more comfortable with predicting rent increases for the next year. But they say their estimate is 7% of an increase nationwide in 2022. And I like that number because it may illustrate a slight return for normalcy. But any other year before 2020, that would have been a gang. That would have been done.
Gangbusters. Yeah. I mean, typically it's around 3%, plus or minus. And so, just quote, demand for rentals will be strong for several reasons. One, the end of mortgage forbearance will cause many home owners to sell and rent instead. We'll see if that happens. A lot of people, they have so much more equity, but as the pandemic subsides, more people will choose to live in cities where it's more common to rent. We'll see if the trend to go more suburban and really rural reverses. I think it easily could, to some degree, or on the margins. In addition, she said the booming labor market and the ability of many knowledge economy workers to do their jobs remotely could also trigger demand for rentals if newly arriving residents want to rent before they buy homes. I hadn't really thought about that, just with all the migration going on. And actually, that makes quite a bit of sense. There's so much shuffling around, and you want to try something out before you buy it. That makes sense.
And if there is this constant, if the rate of migration in general, people get more, they're always kind of moving around. There may be a steady pool of renters that have always just moved and are looking for a new place to live, that might be replaced by another family that just moved in, or couple, or probably single person.
Yeah.
But I thought that was particularly interesting, their perspective on these things as a whole. And I also think that, just talking about this 7% increase nationwide, I would love to see what people think of the demand from investors next year. So are investors expecting a 7% increase nationwide, and are they going to price that into their bids when they're bidding for another project?
Well, they already have. I
Yeah.
mean, why I don't see that. Why that's the story of 2021 from our point of view. I mean, people have been pricing in incredible amount of rent growth, and we've been pricing in a lot of rent growth also because it's. I mean, you have to speculate to some degree, but a lot of it's not even speculation. It's like, no, the market rents have already moved.
Yeah.
I mean, we've changed many ways how we underwrite a deal because it's no longer, we're going to do this kind of value add to, hit this where the market is, well, today, which is only a little bit more. We're going to put this into a different category because of the renovation. Now it's the market rents at the property have already moved $200, and now it's going to take 2 years to get up to this new market rent.
Exactly.
Combined with a value add strategy to even move things further along, it's just this accelerant. And without a doubt.
And that's what I was thinking of too. It because they have factored this in, it's almost like you have to wait that much longer for growth that seems to have been factored in the so it just does seem to change.
Well, it's priced in, but that's where I think it makes the market exciting because it's not as simple as it was.
Yeah.
I think that the element, the risk has increased. I think the return has also increased significantly. I think that there are ways though to quantify that level of risk and mitigate it and to really understand what the downside is. And that's why I love investing in apartments, large apartment buildings in general, is because when you really take a close look and you quantify the downside from the deals that we look for, the downside is, and this is like near worst case scenario. Obviously something could happen that is just, once in a 1 in 1,000 event. But our downside is okay, we're getting 3% cash flow, or 4% cash flow, or even 5%. That's like if things just don't go according to plan, nothing works, and we have a recession, can't get any growth. That's still beating your junk bond yields on junk bonds today. So, and then when I think about the global demand for yield with real yields still deep into negative territory, where are investors going to find such appropriate risk adjusted returns? If I can get, let's call it 6 to 10% on a stabilized multifamily deal, cash on cash, compared to 2, 3, or 4%, maybe on a junk bond. I mean, I guess you can buy a 30-year treasury, closer to, 2.5. Like, who wants to do that? But also combined with the chance for upside. I that's where, and there's other compelling asset classes out there, and even in real estate. I mean, I think industrial and multifamily, that's where you want to be. And industrial includes self-storage, and multifamily includes manufactured housing. But I think that's where you want to continue to concentrate over the next couple of years. What
I wonder, one of my big things I'm kind of watching, and I'll be watching, what happens at Great Capital as much as the market in general, is how much will a return to kind of less ecstatic but still strong rent growth, will that dampen the enthusiasm from the investors, from the investment market? And my expectation really is that it's not. I think there's some serious momentum from interested investors that will continue to make it very competitive to buy.
It's in part of that is that search for yield isn't going away anytime soon. Yeah. We saw that the report on how many baby boomers there are out there. They need income. And how do you generate income in retirement? It's through yields and passive income. And these rental properties, multifamily apartments, specifically large multifamily apartments, are one of the best passive income vehicles that exist. I mean, to get similar yields, you can, in crypto, you can go and, stake crypto. I don't know how many baby boomers are doing that. And even that's getting, 6 to 10%. It's similar yield as multifamily. Now, I guess there's a higher degree of upside potentially in the underlying coins or whatever that you're speculating on, which is totally fine. But especially when I think a lot of these individuals who have been investing in multifamily and real estate, I mean, we saw 40%, kind of on average value increase year over year.
Mhm.
So people are going to, when deals start cycling, which they already have started to cycle over, because people have seen huge value increases, they get high IRRs. People are going to be getting 30, 40, 50, people are going to be seeing 60 to 70% IRRs on some properties, on some deals,
Oh man.
2 to 5x multiples. And we sold a property down in Evansville, held for a couple of years this year, 3.4 equity multiple over a 4-year period. Typically, we're looking for a 3x multiple over a 10-year period. That's considered a good deal. We're doing that in 3.5 years. So when people multiply their capital times 3, they still need to get a yield on that, and they can accept lower yields and lower cap rates and lower cash flow because you just 3 times your money. So you could really divide your
Yep.
whatever yield you need by 3 and still be getting the same volume of cash. Or if it's just a little bit less in yield, you get much more cash.
Well, and that's what it's probably obvious. It's like it does privilege the people that have bought and owned properties before the pandemic, and they will be in this market. They may not see the opportunity, the huge multiples, but they can kind of extend that success because they're in and they're cycling through and they're doing more deals. So yeah, it really pays to be in the market already for sure.
Yeah. And this is where, just circling back, it's being invested in the housing market. Yeah, it's been great past couple of years, but what's so screwed up is like this is like a manufactured environment that we're in right now. It's because the government took certain action and spent $7 trillion in the Federal Reserve, lowered interest rates and buying mortgage-backed securities. This, COVID didn't cause this. The government with the lockdowns caused all of this. And not saying that a lot of things weren't 100% necessary, because we didn't know, and you're fighting a war or whatever. But just looking back objectively, this crazy economy was totally caused by governments and central banks, like 100%. Like the virus, like more people would have died if they didn't do something. So like you have to do something, but the economy wouldn't be so topsy-turvy. And the result is exacerbating wealth inequality. I mean, there's no other way to say it.
Yeah.
If you were already invested in the housing market, you get 40% richer.
Mm-hmm.
If you weren't, you could have lost your job and you could be way behind. Maybe and then they're like, oh, well, maybe you saved up a couple more $100. Your savings rate up to 20, 30%. That's great. Now you've saved a couple $1,000s, but that's nothing compared to if you were invested in, the stock market or real estate or cryptocurrencies. And that's why I think there's so much focus on financial education, people trying to figure things out for themselves. Because if you don't, you're going to be left behind. Unfortunately, that's just the way that the world works. And you just have to take appropriate steps, and you can't just assume all is going to be fine and I'm going to get my next pay increase.
Yeah. And even if this does, let's say this is benefiting existing apartment owners or existing homeowners, ultimately, if things get too far, it's going to start to hurt them. When the economy does bad, then everyone's going to be affected. Even if you had a couple years or a year and a half of low rates and a lot of money. So in the long term, you are looking for a more stable and more predictable and less maybe hysterical or ecstatic environment.
Yeah, are we in the 1920s? Heading towards a Great Depression? I don't think so, but who knows? Or are we in the 50s? With times accelerating, and we're going to be running towards we're going to be rushing into the mid late 70s.
Yeah.
But that whole period of the nifty 50s, all the crazy stuff in the 60s and the 70s, instead of happening over 3 decades or 15 years, it's going to happen over 3 or 4 years.
Yeah.
Or something completely different. History rhymes.
It's so quick though. It does seem like it's happening a lot faster for sure.
Yeah. All right. Well, Matt, I think that's a great way to kind of finish off the last Gray Report of 2021. This is our 32nd episode. Is that right? Or 31st?
Something like that. I'll have to come back and keep track.
I've got them we've got them all numbered. But so very shortly, Matt, not only will you be able to watch the Gray Report on YouTube, but it's going to be available as a podcast wherever you can find podcasts. Matt, do we have a kind of an idea of when this will be all available on,
I think it's
all
a
of the
matter. It's
popular
a week or
stores?
so. And if it doesn't, and if I can't get it up and running in a week, then I made a big mistake. So I will put myself to that.
Yeah. So because we've had a lot of requests, people saying, I love watching the Gray Report. You guys are updating all kinds of great information. But I want to listen in the car. That's where I consume a lot of my media. I'm the same way. So trying to accommodate all of the viewers of Gray Report. But we'd be amiss to not mention where you can stay up to date throughout the week, every single day. And that is by hopping over to grayreport.com. It's on the World Wide Web, www.grayreport.com. It's the #1 multifamily intelligence aggregator out there on that World Wide Web. So we're bringing in aggregated data, articles, all these research reports we've been talking about coming in, again, related to the multifamily industry, real estate, and the economy. There's a lot of stuff here. So it's critically important that you not only have a lot of information, but the best information. And so we've spent a lot of time curating this. So it's only the best stuff, including videos, podcasts, market reports. So hop on over to grayreport.com and make sure, if you have not signed up for the Gray Report newsletter, that was kind of the that was the impetus of all of us. We started with the newsletter, and it's evolved. It gets sent to thousands of people every single Thursday at 8:30 Eastern. Market updates, trends. Matt does a great job putting the Gray Report together. So graycapitalllc.com/newsletter is how you sign up for that. And of course, if you want to learn more about Gray Capital, what we do, how we're buying all these apartment buildings, why we love doing it, graycapitalllc.com is the place for that. Love to have a conversation with you. And if you like this video, please give us a comment, a like, and subscribe to the Gray Capital YouTube channel. That way you can stay updated and be alerted every time we put a new one of these cool videos out. Stay up to date. Matt, any closing words? We're not in the office, which is too bad.
I wish that I had a nice, beautiful, snowy background.
Snowy background, isn't this lovely, right? Pretty messed up. Yeah, I think we had like 1 day of snow in like November in Indy, and it was like 64 degrees on Christmas.
The mild weather. You mentioned this mild weather, lower utility fees, so that's pretty nice.
That is exciting. And we were excited that because we have a property up in South Bend, Granger, Mishawaka MSA, that because of the lake effect by Lake Michigan tends to get a ton of snow. We literally had over $100,000 in snow removal last year. It was nuts. And so every day we don't have to plow snow, we save like $4,000. And then the day we were talking to our property manager, being like, no snow, so we haven't had still no snow. Literally, it snowed that day.
That's nice. Oh no. Well, you don't. Yeah. The watch pot never boils.
Hey, we'll send Jay. Jay. I guess jinxed it according to her. So we'll send Jay the bill.
That's right.
The $4,000 push. That's a big property. All right, Matt. Happy holidays. Happy New Year.
Thank you.
You too. I could have performed Auld Lang Syne. I decided not to. Maybe next week.
Yeah.
All right. Thanks for watching. We'll see you next week.